For a broader look at the issues, I guess, plaguing CBA at the moment, Chad Slater, the Joint Chief Investment Officer at Morphic Asset Management, joins me live from our Sydney CBD studio. Chad, thanks very much for joining us. Now, what are your thoughts around, you're not a shareholder in CBA, but what are your thoughts around this scandal? They have had, there are very serious allegations about them. We understand some offshore banks have also had those similar sorts of allegations on not being diligent enough about money laundering and risk assessment around all that. What are your feelings?
Yes, good afternoon, Helen. Yes, look, obviously there's been a lot of press and a lot of people are quite concerned about it, but if we take a step back and compare it to some of the other global scandals, for example HSBC, where they were found guilty of their employees helping actively money launder Mexican drug money. From that perspective, what is actually taking place at Commonwealth Bank is quite minor. I'm not trying to downplay what's happened here, but trying to give some perspective to it, where ultimately this was an issue and an error with coding, and I'd call it a failure of risk analysis. At the end of the day, CBA employees...
it is a bit more than coding, and they have been accused of not doing really any or enough risk assessment both before and after, even when the AFP, we know all the allegations, even when the AFP alerted them to certain customers, they didn't act quickly enough, all those sorts of things. So it's not just coding.
Look, that's a fair point, Helen. But at the end of the day, what I would say is that ultimately none of their employees, unlike HSBC, actively engaged with physically laundering money. And that would be a much more serious allegation. As I said at the start, I'm not trying to downplay it, but I'm trying to give some context to the matter here. And what you're referring to is a failure of process. And I think that in itself is actually quite interesting. I think that speaks volumes about the complexity of these businesses today. I don't think anyone who's the CEO of these sort of size businesses truly fully understands what goes on inside their businesses, and the complexity of these businesses.
Which is an indictment in itself, isn't it? To think that, someone who's clearly as bright and on the ball, paid huge money as Ian Narev is, and what you're saying is that it's almost impossible for him or anyone of a like-sized business to be across what goes on inside their businesses.
Yeah, look, I can't speak for his personal example, but the businesses we look at and meet with, the CEOs generally aren't the people to speak to if you want an idea about what's going on in the line businesses. That's just the reality of these super large, super complex businesses that exist today. But why do they exist? I think that's the more interesting question. And in the bank's case, they exist because governments have decided that regulation, or more regulation, is the solution. And as they become more regulated, and for example, Morgan Stanley CEO Gorman was on his call recently, said that they have to submit 25,000 pages of documentation once a year to regulators. I truly ask how many regulators read 25,000 pages worth of those documents.
I guess what is the cost of that, both the literal cost and the cost to hours lost in the business?
Yeah, there's a joke in the industry at the moment that the biggest growth area is compliance. And look, on a more serious matter,
I would have an argument with you about, and I'm interested in your view, and we probably haven't got time for an argument now, but that, the reason all this regulation has come in, certainly in the United States, a lot of it came in after the GFC, after there was far too much recklessness that went on inside many of the investment banks. Yes,
a lot of this did come after the GFC. And like trying to stay philosophical in a 5-minute chat, is that what they've tried to do is regulate line by line. And speaking to our chairman, Nick Minogue, used to be on the head of risk at Macquarie Bank globally, and his principles that he works on and works with us on is ultimately principle-based rules work better than rules written in code. That, for example, the fair and competency tests, like these more general tests, working with people are far better than trying to put 25,000 pages of documentation together.
Yeah. All right, let's move on, because I'd like to get your view. I know you don't always invest locally, but reporting season in full swing. But you have, we've talked about shorting before. I mean, the shorts have been in deep in some of these companies who've reported this week.
Yeah, I'd score this 1 for the shorters, 0 for the longs this week on the short sold stocks. That two in particular, JB Hi-Fi and Domino's, have been in the press. And the reason why I point this out is that a lot of short people who hold those positions are offshore-based investors. There's a feeling amongst the long-only community here locally that these people don't really know what they're talking about. That they fail to analyse the business in the length and depth that
the long people say the short don't know what they're talking about.
As a general rule of thumb, I'd say my peers in the long-only community hold that view about the shorters. And I'd say that in both cases here, their views have been vindicated, and particularly in Domino's, that it's been a highly controversial stock. And we had been short the stock, we're not anymore, and we weren't recently. But ultimately, there has been systemic issues across the Domino's business. So I think there's quite a bit of academic evidence that says stocks which are heavily short sold are actually more likely to go down rather than be squeezed up, and I think we've seen that play out this week.
All right, Chad, just finally, I know you do invest in Asian markets because of the rising tensions and some concern around North Korea.
Yep.
What's happening in Asian markets? Are investors staying away?
Yeah, it's been an interesting week or two there. Asia as a backdrop's up about 20% year to date. Last week with the North Korean issues, everything fell quite heavily, like 2, 3, 4%. And what's interesting from our perspective is this week the bidders have come back, but they haven't come back in the breadth and the size they have in the US, which drove itself almost all the way back to its peak the other night. I think there's a general level of wariness and also fatigue. When you're up 20% in the first 7 to 8 months, everyone's a bit fatigued on the long side. So we're a little bit more cautious on Asia at the moment.
All right, Chad Slater, Co-Chief Investment Officer at Morphic Asset Management. Thanks very much for joining us.
Cheers. Thanks, Helen.